Good evening, everyone. Thank you so much to AG Bell and Shares for inviting SDX to present. My name is Mark Reid. I'm the CEO of SDX. I've been CEO for a year. Previously, I was the CFO for 4 years. So I come from a finance background. I was an ex-oil and gas banker, and I'm a chartered accountant by training. So together with the CFO, hope everybody is okay about two finance guys running an upstream oil and gas company. But anyway, more importantly, let's go on to talk about the company. So we're a name-listed exploration and producing company. So I'm going to talk about two things tonight. I'm going to talk about exploration upside and some exciting drilling that we are doing next year, and also about our producing gas and oil. We've got about a 70-30 split in our reserves between gas and oil. Our reserves and resources equate to just over 6 years of production. We produce around 6,500 barrels of oil equivalent per day, and that generates operating cash flow for the business of around $30 million. We have a G&A annualized of about $5 million. So we have around $25 million of free cash flow per annum that we either reinvest into exploration and development, which is what we're going to do in 2021, or we may return some to shareholders if there isn't enough exploration opportunities to go in the future. As I say, we've got sort of 6+ years of production in our reserves at the moment. So moving on to our current production, the right-hand columns, first in from the right and second in, just lets you know that we are producing around 6,500 barrels per day. Our guidance to the market is just between 6 and 6,250. We are likely to fall comfortably within that guidance range during Q4. So we have a very stable and insulated production base, because as I said, we are 70-30% gas to oil. The gas is all fixed price contracted gas, so we have a nice natural hedge to commodity price variations, but our oil portfolio also gives our investors some oil upside. So what I want to talk about now is our key flagship asset, which is the South Disouq asset in the Nile Delta onshore Egypt. As I said, we had 8 concessions all in. This is our largest concession. It accounts for around 70% of our production and reserves, and it's a concession that we have drilled 7 wells into, of which we've had 5 commercial discoveries. So we have a 70% success rate in our drilling. We sell our gas all to the Egyptian state at $2.85 an MCF, but it costs us only 30 cents an MCF to produce. So we've got high gross margins, or netbacks, as it's called in the industry. That asset itself for us generates around $12 million of operating cash flow per annum. However, we will be connecting our latest discovery, which is called Sobe, in Q1 of this year, and that will further increase our operating cash flows by another $1.5 to $2 million. Now, the real story about South Disouq that I want to spend some time on is the exploration drilling that we intend to carry out in the middle of 2021. What you can see on the slide at the moment, on slide 7, is on the left-hand side, you'll see a table of drilling prospects that we have already identified in the concession. And on the right-hand side, you'll see the proximity of those drilling prospects to the Ibn Yunus and South Disouq key producing area, and that's where our central processing facility is. Now, what's really exciting about the wells that we intend to drill, which are called Hanut, which is the first well in the table, and Mosin, which is the second well in the table, is that the size of these prospects have the potential to increase our reserve life from around 6 years to 12 years. So these have the potential of doubling the intrinsic value of the company. As I say, we've had a very good drilling success rate in this concession. We've had the concession since 2015. We've shot 3D seismic over the full concession, and as I say, we are now about to drill wells 8 and 9, where as in an area that we've had a 70% success rate. So these are really, really interesting prospects, very, very exciting, and genuinely transformational, given the doubling impact of our reserves and potential valuation. Now, moving on actually to page 9, which is more relevant, in terms of what these prospects are worth to us, we value the prospects at around $1 per MCF. So the Hanut prospect, which is 139 BCF, is worth at 100% $139 million. The Mosin prospect at 100% is worth $26 million. We have a 55% interest in the concession, and our partner, which is a North American private company, has a 45% interest. Our partner has still undecided due to other capital commitments as to whether they will participate in the drilling, but we are fully funded and intend to drill these wells either jointly with our partner or on a sole risk basis. We would drill them ourselves. And as I've talked about around the potential to double the reserve life, you can see in the bottom right hand corner of the slide, you can see our production profile in terms of what these successes may do. Now, the deep blue production profile is what we are currently producing. You can see it's the South Disouq and the Ibn Yunus 4 wells that we've got currently produce 8,000 barrels per day. The Sobe well that we are connecting and will be on stream in Q1 will extend that plateau out to 2024. But the 2 wells that we're drilling, the Mosin and the Hanut well, are significantly incremental. And as you can see, the Hanut well, given its size of 139 BCF, upon success, will extend our production plateau out to 2033. So a real game-changing potential asset. The well costs are very modest here. They're all onshore, as I've said. So the gross well costs are around $3.5 to $4 million per well. We've got a very strong balance sheet. We typically sit with around $9 million of cash on our balance sheet. We have a credit facility with the EBRD of about $7.5 million, albeit we expect that to go up to 10. But as I touched on at the start, the underlying operating cash flows of the business, from a very sort of stable, predictable and fixed contract base, generates recurring cash flow for us of around $25 million. So we're using the cash that we generate to either go after and drill these exploration prospects, or if we don't think that's the right thing to do with our capital, we will be giving capital back to shareholders at some point in the future. But certainly for 2021, we're very, very excited about our South Disouq assets and these 2 wells that we'll drill. Our other area of exploration next year is in our Morocco concession. Now, our business in Morocco is quite unique in that, other than the state company, we are the only producing company in Morocco. We produce gas and sell it to 8 industrial customers. We are adding a new customer in December. It's actually the second site of an existing customer. Our cash flows in Morocco, our operating cash flows in Morocco, is around $14 million per annum, and this new customer will add another $2 million. Now, Morocco is a very interesting fiscal environment in that it's very energy short, very dependent on imports. Therefore, there's a very high price set if you are fortunate enough to produce indigenous gas, as we are. So we sell our gas in Morocco at between $10 and $11 an MCF, and it costs us just under $1 to produce. The other very attractive aspect of the Morocco fiscal environment is there's a 10-year corporation tax holiday. So, you know, when you're looking at the very high margins that we have with a tax-free period of 10 years per concession, you can see this is a very cash generative asset. So what we are doing in Morocco next year is we are undertaking a drilling campaign of between 4 and 5 wells, which have 2 main objectives. The first objective is that we are going to drill another 2 wells in the area outlined in the sort of white broken line area of our concession. And this is a new area that we were fortunate enough to discover last year with our drilling campaign. We believe that there's 20 BCF of gas here. And we'll be drilling 2 wells to complement the 2 discovery wells that we made in 2019 and 20. These 2 wells, together with 2 further wells to the south. Now, what I've just shown you is the map on the right-hand side. You can see the sort of concession area highlighted with a blue rectangular shape. These are our areas that are covered by 3D. So we'll be drilling 4 to 5 wells in total, 2 of which are in that recently discovered area, and 2 are further to the south, close to our existing pipeline. So the red line that you can see going down from sort of northeast to southwest is the SDX pipeline from our main producing field down into the city of Kenitra, where our customers are based. And we will be drilling 2 additional wells very close to that pipeline, which will complement the other 2 wells in a recently discovered area. So we'll have 4 wells going in next year. The main objective of these wells is to discover and connect additional volumes of gas. And like Egypt, this is a very well understood area. Their historic success rate in drilling in Morocco is around 80%. So we are disappointed when we drill wells that don't find gas, because it is a very well understood and well proven area. That said, the other exciting aspect of our last drilling campaign is that we took our last well in a 10-well campaign and drilled it about 400 to 500 meters deeper than we've drilled anything before, because we saw some interesting prospectivity in that area. Now, we were fortunate enough to make a gas discovery in this area, and as a result of the seismic coverage that we've got from the north to the south, we believe that we've encountered another very prospective and as yet undrilled and uncommercialized area, which could have a significant impact in extending the reserve life of our assets in Morocco. So the well that we drilled, the 10th well, unfortunately wasn't able to be flow tested as a result of the COVID-19 restrictions in Morocco, requiring all foreign personnel and equipment to leave the country. So that well will be flow tested at the start of our 2021 campaign, around about April. And if it tests correctly, and we're cautiously optimistic that it will, we will deepen one of the 4 wells that are the wells that we expect to encounter gas and fit into our pipeline. We will extend and deepen one of the wells to test this new, we call it the top nap area again. And if that is successful, as I've said, it opens up a very extensive new area. And we highlight it on page 12 in the blue ellipse area from the northwest to the southeast. We believe that this top nap prospectivity extends that whole distance down, which means it can be really, really significant in terms of its size. So along with the very exciting and potentially transformational drilling campaign that we have in Egypt during 2021, we have a similar 4-well program here in Morocco. So, between those 2 assets alone, we have 6 wells being drilled in 2021. Moving on to our oil exposure, our oil asset in Egypt, which is in the West Arab, Masada and Rabel fields in the Eastern Desert, so very close to the Red Sea. And what we have here is a very stable oil producing asset that we have a 50% interest in. It produces, as you can see in the bottom left-hand chart, around 3,500 barrels per day, and it will continue to produce that. At today's oil prices, that generates for us around $3 to $3.5 million per annum of free cash flow. At $60 oil prices, that goes up to around $6 million. So it's been producing since 2012. It's got a very low break-even price. So the Brent oil price must be below $20 before this asset becomes challenged. very low drilling costs. I talked about $4 million to drill our high impact exploration wells in our gas business in South Disouq. Our wells here gross are around $750,000, of which we've got a 50% interest. And our big project that kicks off next year is a project to drill and commercialise the 2C wedge you can see on the bottom left-hand chart. We have around 2.3 million barrels of 2C reserves that simply require drilling up and connecting to be classed as 2P reserves. These wells will cover about 8 to 10 drilling activities. It's a very low cost operation, as I say, because the well costs are only $750,000 each. We calculate at today's oil prices that these wells, when you come on stream, for us on a post-tax, post-capex basis, so free cash flow for distribution, will generate to us around $5 to $6 million over the next 2 to 3 years, which will augment our base cash flow, which will still be there of between $3 and $6 million, depending on where oil price is. And indeed, this project, if oil prices do increase, the $5 to $6 million will become $10 to $12 million at an oil price of $60. So again, what I've talked about here is a portfolio across 3 core assets that has stable, predictable cash flow, predominantly gas, fixed priced, but has some nice oil exposure. And as a result of this sort of strong operational cash flow we have, we're going to be drilling next year up to 8 to 9 wells, of which 2 in particular in Egypt are absolutely transformational to the company. So in terms of our valuation, the company is a public company. We have an independent reserves audit undertaken each year. The reserves audit values the underlying intrinsic value of our reserves, and it was valued last year by Gaffney Klein Associates, one of the major audit firms, at $102.4 million on a PV10 basis. When the oil price had a significant downward trend, we recalculated the value of that asset base using much lower prices. So we valued our assets at between $35 and $40, the oil portion of our assets at that price. And we still maintained an underlying intrinsic value of $81.3 million. And that gives you some sense as to the level and the impact of this sort of very robust fixed price gas contract we've got. As I say, our market cap at the moment is floats between sort of 37 and 42, $43 million, and we're trading at under 2 times operating cash flow compared to our market cap. So, with the liquidity we've got, with the cash we've got, with the exploration upside we've got, we feel that that's a very undervalued position. And the final thing I'll say is just to give you a sense as to the level of activity that we're going to be undertaking next year. So if you look at, apologies for this rather busy chart, but if you focus in 2021, you could see there that there is a number of key catalysts in our portfolio. At the top, the South Disouq exploration drilling of the Hanut and Mosin wells, and these 2 wells, as I say, have got the potential to double our reserve base and double our market cap in an area we've got a 70% success rate. In Morocco, we'll be testing the LMS2 well, and if that tests, we will be deepening one of the wells in our upcoming 4-well campaign in Morocco. And finally, as I've said, in Masada, we have 2 wells to drill next year, as well as the start of the conversion of the 2C to 2P reserves program, which will add another well. So a significant amount of activity in the portfolio for next year. With that, I will be happy now to take any questions.
Okay, we've got a few questions here come through the system. What is the reason for Egypt in terms of who you're up against in Egypt?
So Egypt's a very mature hydrocarbon province. Egypt's been producing oil and gas since before the end of the First World War. There are many companies operating in Egypt, but we have been established and operating in Egypt since 2008. So we've been there for 12 years. We've got around 40 people on the ground in Egypt, a very strong country manager, and excellent relationships with the government and the National Oil Company. Now,
Yeah.
you know, the BPs, the Shells, the Totals are all in Egypt, but our business is very focused on onshore, low-cost drilling. These larger companies tend to be focused on the offshore. So we, you know, in terms of competition, it's competition for acreage as opposed to, you know, competition to sell your gas or oil, because everything's sold to the state. So we really like Egypt. We understand it well. The fiscal terms are good, and we, you know, we understand the dynamics of operating there, and are very happy in Egypt.
Excellent. Okay, thank you. Okay, here we go. Are you in the financial position to take advantage of any distressed assets that may arise from the current low and possibly even lower oil price?
Yes, we are. As you can see, we've got a very strong balance sheet. We have you know, $9 million of cash, which tends to stay at $9 million. We've got our undrawn credit facilities, and we have got our recurring cash flows. Granted, they are earmarked for the exploration drilling next year. But yes, I mean, we constantly look at ways of growing the business. We've got a very enthusiastic and optimistic key shareholder, which is an Abu Dhabi-based institution called Waha Capital. Waha Capital own just about 20% of the company and have said that they want us to be bigger. You know, bigger through success in the drill bit, but bigger through making sensible, strategic, and accretive acquisitions. So we are looking, you know, we are looking quite seriously. Yes.
Okay, excellent. Excuse me. So this one here. Some of the producing fields in South Disouq are on the margins of the license. Do you think it might be worthwhile obtaining the adjacent licenses if possible? Interesting question.
You're absolutely right, and yes, we are looking at that very closely as well, because as the very perceptive investor noted there, that a lot of our prospects probably do spill over into the adjacent acreage. So that's a program and a process that we are working pretty hard on. Yes.
Okay, excellent. Okay, that's good news. And just going back to Morocco, how do you think potential new producers such as Chariot or Sound Energy might affect your business, assuming they ever produce? We know the history of those companies.
Yeah. So, I mean, Chariot's got a very interesting offshore prospect. Could be up to a TCF of gas. We understand that Chariot would look to sell that directly to the Moroccan Electricity Authority, so they would not be direct competition. We sell our gas to individual industrial consumers, with Chariot, I think, would be selling their gas to the state. Now, it's got quite a challenge in front of it because it's an expensive offshore project that it's got to develop. It's quite expensive. I wish them well. I know the people at Chariot very well, and they're great people, but I don't see that as competition to us. Sound, again, is in a different position in that it hasn't proved commerciality of its assets yet. I think it's had some interesting drilling results, but again, I'm not so clear as to how quickly they can build a pipeline and commercialise their gas. And I say our customers in Morocco are on 5- and 10-year contracts also. So we have got our customers locked in quite securely, we believe.
Perhaps we should get the both of them on to do a presentation to tell you where we are.
No, that would be good.
Your share price has been a poor performer in the last 4 to 5 years. While I understand you've been operating in these areas for a good number of years, given the high profit margin, is there a risk of your selling price coming under government pressure, which would diminish the shareholder return?
So I missed the last part of the question a bit. Was it the oil or gas price coming under government pressure? Was that what you asked, Chris?
Yep. Yes, that's right.
Yeah.
It was the I'm just reading it again. It's the oil, yeah.
Yeah, so obviously oil's a global traded commodity, and it's supply and demand that impacts that. Our natural hedge to low oil prices is having a very low operating base. And as I say, our key asset, our key oil asset rather, which is the Masada and Rabil fields, have a break-even oil price of $20. So we are fairly resilient by virtue of the fact that we're a non-shore, low-cost producer, and that's really our ethos. We build natural hedges into our business through either fixing gas prices on long-term contracts or ensuring that we operate oil assets very, very sensibly and at a low cost to protect ourselves. So the commodity price is important, but we see it maybe as something that triggers some upside in us as opposed to gives us concern.
Okay. Time for one more, I think. Given the low market valuation of the company, do you also consider stock buyback / dividend instead of extra well drilling with the free cash flow?
Yes, we do. Absolutely, we do. I mean, it's a key discussion and debate at our board meetings every quarter. In 2021, however, we feel that the potential upside that we have in these transformational wells that we're looking at in South Disouq justify, for 21 only, for us to allocate our free cash flow to that project. However, every quarter and every year, this is debated and challenged. So with the free cash flow we've got, it's entirely plausible that we will at some point undertake a share buyback or install some dividend. It won't be in 2021, but it's definitely something it's in close discussion.
Okay, fine. Just one more I think I've got here to come through. I don't know if you've covered this off already, but I apologise if you have. Using an oil price of $60 seems unrealistic at the moment. Have you got any further thoughts on that?
I agree. I mean, we run our economics at $40, our oil economics at $40. There has been, and if you look at the analysts' long-term oil price, there is an expectation that we're going to see a recovery in oil price in second half of 2021 into 2022. And indeed, the planning prices of the majors and the price decks that the equity analysts use show an increase to late 50s, early 60s in about a year's time. But, you know, as I say, we're kind of prudent oil operators. We just run our budgets at $40 oil. But again, our business is, as I say, 70% fixed price gas. So it's not a major concern for us. But I agree with whoever asked that question. It would be imprudent, I think, to run it at anything closer to anything more rather than sort of $40 to $45.